Hi, this video is an introduction to preparing financial statements for a sole trader, and we're looking initially at an income statement. And in an income statement, the main parts of it are the sales, where you record income earned from the sales of product or services, and if there are any sales returns, it'll get reduced by that. Sales less purchases, and that's the cost of buying goods for resale or goods that the business is going to sell on. And then purchases in itself gets adjusted for opening inventory, closing inventory. It gets reduced by purchase returns, and if there are any transport costs of purchases, sometimes called carriage in. We look at those items, and sales less purchases gives you gross profit. And the other name for adjusted purchases is cost of sales. So really, sales less cost of sales is gross profit. We add any other income, and these are examples of other income that a sole trader might receive. And then less expenses. And expenses are expenditure on day-to-day costs of running the business. And here are examples of expenses. So here's an example of a question. We are given a trial balance, and you're asked to prepare an income statement and a statement of financial position. And there are two columns in the trial balance, debit and credit. And that's the whole question. And to do this, you have to be able to pick out the sales, the income accounts or the revenue accounts, and the expense accounts and asset accounts. For the income statement, you need to be able to pick out the sales account or income accounts and then the expenses. So I'll just concentrate on them first before looking at the statement of financial position. So the first income account is sales, and that gets recorded at the top of our income statement. And then the purchase account will be next as part of cost of sales. So all you do is go down through the trial balance and identify expense accounts. So purchases is a cost of sales expense, and then the other money spent on day-to-day running expenses, these salaries, motor expenses, insurance, and general expenses. Everything else is either asset, liability, or equity, and we look at them separately when we finish the question. And you'll notice that all the expenses are on the debit side, and that's on the debit side of the trial balance. You'll always have either an expense or an asset. The income statement is basically going to be the sales less all the expenses, and that will give you the net profit, which looks like this. I've just taken the amounts from the trial balance. Your total expenses are 17,550, giving net profit. Now, the only problem with this is we haven't shown the gross profit. So it's easy at the top is our sales minus all expenses is net profit, but we need to divide it up and show the purchases. Sales less purchase gives gross profit. We're still going to end up with the same answer, but it's just going to look slightly different. So sales less purchases, 14,000, gives you gross profit of 4,000, less the other expenses, and then that's our net profit of 450. So it's still the same except as what I did in the last page, except you need to show purchases in its own area, and we call that area cost of sales. So sales less cost of sales, and cost of sales will be purchases adjusted for opening and closing inventory, and any purchase returns. We'll see it in other questions. And then your gross profit less your expenses gives you the net profit. You'll remember the question asked us to prepare an income statement and a statement of financial position. So a statement of financial position is a list of your assets, equity accounts, and liability accounts. And here are example assets are tangible, intangible items the company owns, or resources the company owns or has rights to that have value. These are examples of non-current assets, assets that are expected to last longer than a year. And normally these are depreciated, they lose value every year through wear and tear, apart from land. Land doesn't ever lose value unless it gets written down due to an economic crash, but it doesn't get used up. Unless, of course, it's a quarry, and then it's not a non-current asset. It'll be a kind of part of the goods. But anyway, there's So we expect to see those as assets and land. Current assets are short-term assets the company owns, so you can see examples of them there. The other type of assets are intangible, such as goodwill or patents, or financial, which are those items which are held as investments. For first year, we'll only really be concentrating on non-current and current. Next semester, you might see some intangible and financial. Remember the statement of financial position or the balance sheet, you list your asset accounts, then your equity accounts, and we normally, at this level, of your studies, have only three types of equity accounts. Capital, which is the owner's investment in the business, less drawings, which are resources that the owner has taken out of the business, plus any retained profits, or less if there are retained losses. And then the remaining items are liabilities. So obligations and money owed to third parties, such as long-term loans, and then these items, so payables, items bought off suppliers on credit. Bank overdraft accruals, items owed at the year end or outstanding. So here is the question, the trial balance, and all you have to do then is identify which are assets, which are liabilities. You'll see here premises, motor vehicles, receivables, and then cash held. They're all assets. And you'll see once again they're on the debit side of the trial balance, which is made up of asset and expense accounts and expense accounts. And then the other account here, payables, that's a liability account, money owed at year end. And there are two equity accounts, capital and drawings. And remember, I said there are three equity accounts, capital, less drawings, plus profit. And your profit, in this case, is going to be the net profit, what we worked out in our income statement is the difference between our sales less all our expenses. So here's a simplified version of the statement of financial position of Brendan Doyle, or B. Doyle. Here are all our asset accounts. They add up to 6,300. Now, we need to divide them up into current and non-current, but really, I'll show you that in a second, just to let people see what it looks like in total, or in simplified form. Our equity and liabilities then are next. So equity is always these three accounts, capital, less drawings, plus retained earnings, and the retained earnings is the net profit we calculated in Part A in our income statement. And then liabilities are payables, money owed to suppliers or creditors. And you'll note that the total equity and liabilities are 6,300. So the total amount invested in assets or owned by the company as assets is 6,300. Where the company got the money to buy those assets are borrowed 1,540, and the rest came from the owner's investment in the business between capital invested, less any drawings, plus any retained profits that was kept in the business. So, and a bit like the income statement where we need to show the cost of sales, in the statement of financial position, we need to divide the assets up between non-current and current. So I've just done that here. We still get the same figure, 6,300. Our equity and liabilities are here and they don't change. They're always the three. And our liabilities get divided up between non-current and current. So there is the income statement. Net profit of 450. And here is the statement of financial position, which is our assets, which are divided between non-current and current. On the top half is the total assets, 6,300, and the bottom half of the statement of financial position should equal 6,300 as well, which it does, and it's made up of equity and liabilities. And liabilities are divided between non-current and current. Thanks for watching. I hope that was useful.